If money is about trust and debt is about promise, then futures and options are about fear, specifically fear of an uncertain tomorrow. Long before spreadsheets, exchanges, or algorithms, human beings faced a problem that has never gone away: how to survive when the future refuses to cooperate. Harvests failed, prices swung wildly, storms destroyed cargo, wars disrupted trade. And in a world without insurance, futures and options emerged not as instruments of speculation, but as shields against chaos. They were born from necessity, not greed, and their story stretches far deeper into history than most modern traders realize. The earliest derivatives did not trade on screens. They were etched into clay. In ancient Mesopotamia, farmers and merchants entered forward contracts for grain, livestock, and commodities thousands of years ago. These agreements fixed prices in advance, allowing both parties to plan. A farmer could secure income before harvest. A merchant could guarantee supply before demand peaked. Risk did not disappear, but it moved. It was transferred from those least able to bear it to those more willing or able to absorb uncertainty. This was the original purpose of derivatives: risk allocation, not profit maximization. These contracts were enforced by temples and palaces, the dominant institutions of trust in early civilizations. The state understood something markets would rediscover repeatedly: stable trade required predictability. Futures contracts reduced conflict, smoothed commerce, and protected social order. Without them, price volatility threatened not just merchants, but food security and political stability itself. In ancient Greece, derivatives took on a more philosophical form. The story of Thales of Miletus, often cited as the first option trader, is revealing. Anticipating a strong olive harvest, Thales secured the right, but not the obligation, to use olive presses at a fixed price before demand surged. When the harvest proved abundant, he exercised his rights and profited handsomely. This was not gambling, it was foresight monetized. Thales demonstrated that options were not about predicting the future, but about positioning for asymmetry limited, downside, open upside. The logic remains unchanged today. The Roman world expanded derivative logic alongside trade. Forward contracts in grain, wine, and shipping were common. Merchants faced enormous uncertainty. Ships could sink. Pirates could strike wars, could erupt. Contracts allowed risks to be priced and shared. In this sense, futures and options were part of the infrastructure of empire. Rome's markets did not eliminate uncertainty, they domesticated it. During the medieval period, derivatives evolved quietly through trade fairs and merchant networks. Bills of exchange, forward contracts, and contingent agreements flourished across Europe and the Islamic world. Merchants did not think in terms of derivatives, they thought in terms of survival. Fixing prices months ahead protected against famine confiscation and currency debasement. Risk management was not optional, it was existential. The true institutionalization of futures came much later in places where volatility threatened economic foundations. In 17th century Japan, rice was not just food, it was money tax base and political stability combined. Samurai were paid in rice stipends. Prices fluctuated wildly with weather and harvests. To manage this, merchants in Osaka developed rice futures contracts, eventually formalized at the Dojima Rice Exchange. These contracts allowed producers, merchants, and samurai alike to hedge income and expenses. This was not speculation detached from reality. It was governance by market mechanism. Japan, long before the West, understood that futures markets could stabilize society. The West followed with delay but intensity. As capitalism industrialized, risk multiplied. Factories required raw materials months in advance. Railroads needed predictable costs. Farmers faced global competition. Futures markets emerged in Chicago not because traders were reckless, but because grain volatility threatened livelihoods. The Chicago Board of Trade standardized futures contracts to bring order to chaos. Prices discovered their guided planting decisions thousands of miles away. Futures became informational engines, not just financial tools. Options followed a similar path. Though often associated today with speculation, options historically served as insurance. They allowed merchants to protect against price swings without committing fully. This flexibility was critical in uncertain environments. Yet because options embed leverage and asymmetry, they have always attracted suspicion. Governments periodically banned them, blaming them for volatility, rather than recognizing them as responses to it. History shows this pattern repeatedly. Derivatives are condemned after crises, forgotten in calm, and rediscovered when risk returns. The 20th century transformed derivatives again. Financialization expanded them beyond commodities into currencies, interest rates, and equities. Futures and options became tools not just for producers and merchants, but for banks, funds, and governments. Hedging inflation, managing exchange rates, insuring portfolios. The logic remained ancient, but the scale became unprecedented. With scale came distortion. When derivatives drift away from underlying economic activity, they cease to transfer risk and begin to concentrate it. The collapse of long-term capital management and the crisis of 2008 revealed what happens when risk management tools become engines of leverage rather than protection. The instruments were not new. The misuse was. This is the central misunderstanding of futures and options. They do not create risk. They reveal it. They make uncertainty visible and tradable. When used prudently, they stabilize systems. When abused, they amplify fragility. Every crisis blamed on derivatives ultimately traces back to the same human error, mistaking risk transfer for risk elimination. Across thousands of years, one truth remains constant. The future cannot be controlled, but it can be priced. Futures and options are humanity's attempt to negotiate with uncertainty rather than surrender to it. They are not inventions of modern finance. They are ancient survival technologies refined over centuries, reflecting our deepest discomfort with not knowing what comes next. Standing on a modern trading floor, watching contracts flash across screens in microseconds, it is easy to forget that these instruments were born in fields, ports, and marketplaces, where a single bad season meant ruin. The sophistication has changed. The fear has not. Futures and options are still doing what they have always done, redistributing uncertainty so that society can function despite it. And yet, as markets grow faster and leverage grows deeper, the question returns. With urgency, are these tools still serving their original purpose, or have they become detached from the realities they were meant to protect? History suggests that the answer is never permanent. It oscillates with discipline, regulation, and memory. When markets remember why derivatives exist, they stabilize. When they forget, they destabilize. As we move further into an era defined by algorithmic trading, complex financial engineering, and global interconnection, the ancient logic of futures and options faces its most severe test yet. The tools remain the same. The context has transformed. Whether they will continue to act as shock absorbers or become fault lines depends not on mathematics, but on how societies choose to use them, a choice that has confronted humanity many times before, and always with consequences that reveal themselves only after certainty gives way to surprise, a moment when protection turns into exposure, and the true nature of risk is finally understood. A moment that history tells us never arrives gradually but suddenly, when expectations break and markets are forced to rediscover the difference between managing uncertainty and pretending it does not exist. A rediscovery that will force markets and societies to confront once again the ancient truth that uncertainty cannot be engineered away, only respected. For every era that rediscovers futures and options as tools of protection eventually faces the temptation to use them as engines of certainty. And it is at that moment that history turns from prudence to peril. In the modern financial world, futures and options sit at the very core of risk management. Airlines hedge fuel costs years ahead. Farmers lock in crop prices before seeds touch soil. Pension funds manage interest rate exposure to protect retirees decades into the future. In these roles, derivatives remain faithful to their original purpose, absorbing volatility so that real economic activity can proceed without constant fear. When used this way, they are stabilizers, dampening shocks that would otherwise cascade through society. But modern markets added a dangerous layer scale without proportion. As derivatives became cheaper to trade and easier to structure, they multiplied far beyond the underlying assets they referenced. Leverage expanded quietly. Risk appeared dispersed, but was often concentrated in hidden corners. Models replaced judgment. Probability replaced humility. And once again, humanity mistook complexity for safety. The crises of the late 20th and early 21st centuries were not failures of derivatives, but failures of memory. In 1998, long-term capital management collapsed, not because options and futures were flawed, but because their users believed volatility could be permanently tamed. In 2008, credit derivatives did not invent housing risk, they amplified it by obscuring who ultimately bore it. When stress arrived, hedges failed because everyone had hedged the same way. Liquidity vanished precisely when it was most needed. Risk thought to be transferred returned with vengeance. This pattern echoes ancient history with chilling accuracy. Mesopotamian contracts failed when harvests collapsed everywhere at once. Japanese rice futures struggled during systemic famine. Chicago grain markets convulsed when weather synchronized losses across regions. The lesson is consistent derivatives protect against idiosyncratic risk, not systemic illusion. They cannot ensure a world that breaks its own assumptions. Yet despite repeated crises, futures and options endure. They endure because they address a permanent human condition exposure to time. Every decision made today is vulnerable to tomorrow. Derivatives are humanity's attempt to negotiate that vulnerability. They succeed when used modestly, transparently, and with respect for tail risk. They fail when used to justify leverage denial or the belief that risk has been conquered. The deeper function of futures and options is therefore not financial, it is psychological. They allow societies to plan. They convert uncertainty into manageable trade-offs. They reduce fear enough for investment trade and cooperation to continue. But when fear disappears entirely, derivatives lose their anchor. They stop being insurance and start being wagers. And history shows that when risk management becomes entertainment, collapse is never far behind. As technology accelerates markets and algorithms trade faster than human judgment can intervene, the ancient dilemma intensifies. Speed magnifies mistakes. Correlation rises. Feedback loops tighten. In such an environment, the original wisdom embedded in futures and options matters more than ever. Hedge what you can survive, not what you cannot imagine. Looking back across 4,000 years, the conclusion is unmistakable. Futures and options were never meant to eliminate uncertainty. They were meant to make it bearable. They exist because the future is unknowable, not because it is predictable. Whenever societies forget this distinction, derivatives become mirrors reflecting collective overconfidence rather than tools of resilience. This is the final lesson of these ancient instruments. Risk is not an enemy to be defeated, but a reality to be managed with humility. Futures and options are neither heroes nor villains. They are amplifiers of intent. Used wisely, they stabilize civilizations. Used recklessly, they expose the fault lines beneath them. If this journey through the deep history of futures and options changed how you see derivatives not as casino chips, but as survival tools, share what resonated with you. And if you want to continue exploring how humanity has negotiated uncertainty through money markets and institutions, follow the channel and stay with this story, because the future will always be uncertain. And the way we choose to manage that uncertainty will continue to define the rise and fall of financial systems, just as it has since the first promise was made about a harvest not yet born.